Good morning. I'm Kristen Balasia, Head of Automotive Advisory at IHS Markit, and welcome to this edition of Fuel for Thought. Today, I'm joined by my colleagues, Peter Nagle, Senior Economist in our Light Vehicle Sales Team, and Mark Fulthorpe, Executive Director, Global Light Vehicle Production Forecast. Good morning. Good afternoon to both of you.
Hey, Kristen. Good to catch up with you.
Good afternoon.
Good morning, gentlemen. As we're nearing the end of a challenging, to say the least, 2020, we're now looking to 2021. So what we're going to be doing is talking about the 2021 outlook this morning. Looking at what may be in store for the auto industry. We're all hoping for change. There's some positive influences and some uncertainty as well. We see daily promising news as recent as yesterday and today around vaccines, policy actions, while at the same time, many regions are implementing measures in response to a second wave of COVID cases and a number of stories where cities are locking down again. Peter, based on how these efforts pan out and in what time frame, what can we expect to see as we start 2021?
Yeah, Kristen, I think we've really arrived at the crucible of the pandemic here. As you mentioned, vaccines are shipping out not only in the UK, but just started distribution here in the US. However, on the pessimistic side, we've started to see an increase in lockdowns, particularly across Europe, but also rising here in the US as well. So when we look at the trajectory as we move into 2021, it's really balancing between those two poles: the confidence that we'll have a vaccine and that hopefully the pandemic will soon be ending, and the fear that the next several months could be the bleakest yet. So when we're looking at what that means for light vehicle sales, well, we expect sales to be down in 2020. GDP is expected to be down sharply across the globe. As we move into 2021, we do see in our base case scenario here a strong recovery and not only global GDP growth, but vehicle demand, as really most of the recent news is favoring the improvements in the economy, as opposed to the lockdowns being as stringent and as cutting to growth as previously expected. So we expect GDP growth to decline about 4.5% this year, probably a little bit better than that as we've seen some recent data that's surprising to the upside. As we head into 2021, we expect a pretty much a reversion of that, with global GDP growth accelerating to about 4.4%. Really being led by strong improvements in the Asian economies, but also North America faring pretty well. Europe will tend to be a little bit of a laggard in this outlook. From a vehicle perspective, vehicle sales are expected to fall to about 75 million units this year, but a strong bounce back to about 82 million in 2021, really being driven again by strong growth in China, but also the US recovering fairly quickly as well.
Yeah, thanks, Peter. And the way you described that with the lockdowns, like you said, going on now again across Europe and other parts of the world, and the vaccine out on trucks, rolling down the highways out for distribution, I like to call it, instead of the calm before the storm, I think we're kind of in the storm before the calm, hopefully. So that's really interesting. And so moving, to all of those types of topics, Mark, at the same time, we can't forget there's still this little thing going on called Brexit, right? And with a no deal exit, still a possibility. And the auto industry is global, has a global supply chain, relies on relationships and trade implications and tariffs that we can all rely on and predict. And really, we could see a pretty significant impact with tariffs on car parts and levies on finished cars. Can you talk a little bit about that and the exposure across the EU?
Sure, yeah. Just to point out, first of all, those trucks are rolling down to Kalamazoo, so it's a Michigan effect, certainly for the US. But yeah, you mentioned you mentioned tariffs and the potential change in those regimes, and yes, we've been studying the impacts of that, and in fact, we recently updated clients with a view of our sort of no deal Brexit scenario and how it would affect light vehicle production. But I think one of the things that's really kind of focused the mind in the last week, perhaps, is not just tariffs themselves, but more importantly, some of the non-tariff disruption that the sector could be facing. When we just realize, how important it is to have the smooth delivery of parts into the UK and from the UK into the European Union. And of course, many of these parts, if not most of these parts, are being delivered on a just-in-time basis. So there's a physical aspect which I think really in the immediate short term could in itself be the most disruptive factor if there's no deal. And in fact, we've already we've seen a little hint of that based on what happened to Honda's UK operations last week. And it shows just how finely balanced these supply chains are in respect to unhindered movement across borders. Honda, just-in-time sequence delivery of parts. They ran into an issue where parts that they were bringing into the UK, taking them off container ships, the problem was that containers to go onto container ships are in really short supply at the moment, as lots of other sectors recover from that first wave of lockdowns in spring, and they're also running into the pre-Christmas rush of deliveries, and also especially relevant to the UK. There's a degree again of not just autos but other industries and sectors starting to try and stockpile ahead of that potential disruption at the turn of next year. So yeah, there's some real things to consider there, and perhaps, as I say, they've been brought more into focus recently. So but we also, while we're no closer to understanding the terms of any deal, the failure to agree by the end of the transition period, so just to remind everybody, that's December 31st this year, that would force a new sort of decision-making process on those OEMs who are involved in volume manufacturing here in the UK. We assume that if a no deal set of conditions were to prevail across the horizon, then it's going to be very difficult to make a case for continued long-term presence in the UK. We consider that exports would gain some short-term relief if, as expected, there would be a further devaluation of the pound sterling based on a no deal. But of course, this would be tempered by an increase in input costs. So all of those parts being brought into the UK, which may be denominated in euros, yens, dollars, RMB, they will become more expensive as well. And of course, we also have to consider the additional costs surrounding extra bureaucracy, form filling, whether it's a physical form or whether it's online. It's going to take time. And what additional costs will be incurred if the industry has to think about stockpiling at levels which it has not been used to for perhaps 20, 30 years. So against that background, we're constantly monitoring the developments, but we don't expect any immediate decisions to be made on the future of the UK facilities, but rather that the OEMs will review their investments as each vehicle comes to the end of the cycle, and this may give them the opportunity to sort of see what kind of policy responses may arise in the aftermath of no deal. There's nothing apparent at the moment, but certainly news here in the UK suggests that the government is focused on those industries and sectors that would be most dislocated, and it could be that they will do something to try and ameliorate things for the automotive industry. So it's unlikely there'll be no effort to find any sort of sector-specific arrangements. But I think the balance will be: would this become evident enough early enough to give OEMs reason to sort of pause and consider those investments? And if not, if it starts to drag on and the uncertainty is continuing, then we'd expect to see volume manufacturing start to relocate, either within the European Union itself or in areas which have tariff-free arrangements already in place with the European Union. And in that case, places like Turkey, Japan, or possibly even Mexico could benefit. So that's kind of the view that we have at the moment and what we're thinking about.
Okay, and what about the impact or effects beyond the EU?
Yeah, I mean, beyond Europe, we'd expect the effects to be less dramatic. But exporters to the EU and UK markets, they will need to factor in a decline in market size that would result from economic disruption right across the region. So, if we're exporting from Spartanburg or Tuscaloosa, no deal is going to reduce the size of some of those end markets. And it's the UK market itself that would be most impacted. So that's where the greatest exposure to risk is in terms of demand. And against that, the highest risk that's been identified so far would be for production plants in Germany, Spain, Czech Republic, typically building German premium brand products and some of the market leading products from Ford and Volkswagen Group. So they would be most at risk due to the decline in the UK market size, and then conversely, the risk to UK operations lies in the EU itself, because that is the destination for over 50% of vehicles exported from the UK.
Okay, so Peter, going back to COVID, there's certainly been some upside, right? We've seen challenges. We have the Brexit situation going on, but we've also seen some opportunities. And in a recent study we conducted, in fact, we've seen private ownership in many countries increase for first-time buyers looking to reduce that dependence on maybe unavailable or just not comfortable or concerning shared ride sharing or public transportation. And also, as we mentioned, this positive vaccine news starting to drive momentum. What's maybe more optimistic? I think what you talked about before was kind of the base case. What's a more optimistic evaluation of 2021 in your view?
Yeah, so first, let me be clear. Optimistically, we're not changing any of the vaccine time frame here. So across our scenarios that we've been modeling, we pretty much have locked in that a vaccine will be widely distributed across mature markets, largely in the Northern Hemisphere, in the second half of 2021. So it's not the assumption that a vaccine is already proven out and is arriving earlier than expected that's going to be driving the optimistic outlook. It's really that boost in consumer confidence, that they know that the pandemic is likely going to be short-lived. And so that's going to be encouraging more consumer spending. It's boosting the demand outlook across the board. And it's really that factor that the vaccines have been through trials that consumers are starting to see shots go into people's arms. And that's really boosting their outlook, despite some of the sharp recessionary conditions we're seeing in the market. And it's that, and I think you hit on that beautifully, Kristen, here, is that we are seeing demand increase for private car ownership, despite the deterioration in economic conditions, because consumers are afraid of public transportation. They are a little bit more skittish about hopping in the Uber or the Lyft or the Metro. And that has boosted demand here above levels that we'd expect in a recession here. And so although the decline here in the US was pretty sharp, and declines in China and Europe also pretty sharp, they're really not as prolonged here as and as depressed as what we saw during the global financial crisis in 2008, 2009. So we had a sharper decline, but the recovery cycle has been much quicker already. And optimistically, now that the vaccines are on the horizon, we could sustain that trajectory for a lot longer here. So optimistically, we look at a market that potentially could begin to start flirting with that 90 million units by 2023. We look at that 2021 level at about 86 million units. So that's a pretty sharp climb of about 11 million units from 2020. And really the fastest growth being in North America and the Asian markets here. As the consumer responds positively here to the vaccine being on the horizon. Now we do start to see some other forces perhaps driving that optimistic outlook as well. With the shorter pandemic, with vaccines on the horizon, that's going to put less pressure on labor markets. That's going to put less pressure on those government, both fiscal and monetary support mechanisms that have been backstopping the economy. And we could start to see some of those resources being shifted elsewhere and other possibilities to boost growth, all of which would make 2021 a much stronger year, not only from the 2020 baseline, but relative to our base forecast here for 21. That stronger consumer confidence, better labor market conditions, really supportive of a stronger recovery and vehicle demand over the next several quarters.
So, Mark, you talked about Brexit, but maybe just briefly, what's your view of a more balanced outcome?
Absolutely, yeah, and I think it's it's worth reiterating on this call that when we talk about Brexit, that is a separate scenario that we run and that we've been thinking about, and we haven't sort of pulled the levers and made that part of our base case forecast yet. We'll let them continue talking before we get to that point. So the base case is it starts to look a little more optimistic. I mean, I think as we've chased down the end of 2020, we've continued to upgrade the outlook for China, and that's been based on some very, very strong sort of fundamentals of demand in that marketplace. I mean, really now since Q2, it's been moving forward very, very strongly, and we don't see anything necessarily to derail that progress right now. So China continues to be buoyant, and we're starting to reflect more of that across 2021. Europe, not just Brexit, but we did have a sort of a more immediate impact on our thinking in the last sort of 4 or 5 weeks, and that was what we considered the impact of some of these secondary lockdown measures, which were brought in across a number of countries, particularly in Western Europe. And some of our initial analysis there suggested that perhaps sort of 30% of the retail sector could be taken offline across Western Europe. So I think it's probably going to be proven that we were perhaps a little overly cautious in what we thought the impacts were there. The evidence is tending to point us in the direction that second time around, the automotive retail sector was a lot better prepared. It was a lot more familiar with online transactions, and has really kind of stood up a good job there. Also, kind of as that threat recedes, we're seeing some we're seeing some upside which offsets that coming in from markets in the eastern side of the region, so Russia and Turkey. So overall, they're going to give us support through the base case as we go into 2021 as well. And then coming back to North America, and Peter stressed there, we're seeing really sort of strong automotive demand continuing. And this is creating kind of almost a kind of, a benign problem for the manufacturing side. That pace of demand growth is really proving very, very difficult for the manufacturing side to keep up with. So we've seen a gap in stock levels or inventory, which emerged back in the second quarter. And the game of catch up is very, very difficult. Obviously, we've got new working procedures, to be kind of COVID compliant. So that constrains a little bit of capacity. Many of the vehicles which are really popular capacity is maxed out on some of those lines as well. So it's going to take us a little bit longer to catch up with some of that. So we think that upside potential of restocking in the North American market, that's going to remain a positive right across 2021 now. So if you put the sort of, the three major regions together, and it's largely positive in the other regions as well, we think we're going to now end 2020 somewhere nearly sort of 17% adrift of last year's full build. It's going to leave us at about sort of 74 million units built, but we can add just over 10, we think, to the balance next year. So 84.3 is the latest forecast, and that would mean that we get a rebound of 13.7% next year. So that's where the base case is. Plenty of risks remain, of course, but really, we do continue to see the upside in most of the forecast upgrades that we're making.
So, Mark, I think that was a good segue, Peter, to you bringing us home. So most of our contingency planning, and I think probably the industry contingency planning, has centered around the pandemic. What else is lurking?
Yeah, I just want to circle back. Mark made a pretty good point about European retail, and I just wanted to drive home from a U.S. perspective here that, although we're in the second phase of lockdowns, we aren't seeing as dramatic of a retail impact as we had previously, as to the point that consumers are better equipped, a better understanding of how to handle the retail transaction process online only. That's really helped prop up demand. And so we've seen retail demand here in the US really positive year over year since September, which is a pretty dramatic divergence from what we saw in April and May, where retail demand had plummeted 60, 70, 80% in some US markets. On the fleet side, we are still seeing some weakness, and that's really going to linger into 2021 and factored into the base case here. And then we start to look at some of the other risks out there that aren't enfolded into the pessimistic scenario. Top of mind is really rising energy prices and changes in emissions regulations globally. Just prior to the pandemic, we had the U.S. attack on Qasem Soleimani. Just a few weeks ago, there was possible Israeli targeting of an Iranian nuclear scientist. There's always the risk for rising tensions in the Middle East. That's always been in the background behind Brexit throughout 2020, or behind the pandemic throughout 2020. Mark has touched on Brexit wonderfully. I don't think there's much for me to add to that discussion. But there's also now changes in some of the public policy that are really going to be conducive to either helping boost that upside or driving the downside even further. We look at the expiration of some of the labor market furlough schemes adopted across Europe, the ending of the pandemic unemployment assistance here in the US, all of which could result in hits to consumer wallets. Not likely new vehicle buyers, but really pulling money out of the economy just when we need more money in it to really kickstart and supplement growth. Could be a potential source of weakness. And then we always have kind of the lingering political concerns. Obviously, here in the U.S., all eyes are on Georgia with the January 5th runoffs to see what kind of Senate we have here in the U.S., which could shape not only U.S. policy, but help shape global trade policy. And then we start to run into some of the European election season and possible concerns, in Germany, who's going to replace Angela Merkel at the helm, changes in Spain and Italy, which could help shape the course of the outlook. I would say on the pessimistic front, on our pessimistic forecast, these rising containment measures weren't expected to be as severe. But if we have to lock down further, and we've seen announcements to that effect in Germany recently, we could push sales lower and remain lower through the first half of 2021. So while on the optimistic front, we'd be looking at a market that could be potentially flirting with the high 80s, 86 million is our current optimistic forecast. In the pessimistic scenario, increased lockdown measures, diminished economic confidence, we could see the global market struggling to break that 80 million unit threshold for a second year in a row, with the pessimistic outlook for 2021 currently pegged at about 77.5 million units. So a pretty big divergence here. And as you'd expect, as these two trends are really playing out concurrently.
Great wrap up. Thanks, Peter. And thank you, Mark, both for joining this episode of Fuel for Thought. We'll be back with more Fuel for Thought in the new year. To opt in to our newsletter that provides more information on this topic and others, visit ihsmarket.com/auto newsletter. Thank you. Have a great day and stay safe.